When most beginners look at price chart for the first time, they see chaos, random lines going up and down, numbers that don't seem to connect. But here's what I want you to understand. A chart is not a chaos. A chart is a story. Every candle, every swing, every line is telling you something about what buyers and sellers are doing in the market. And so once you learn how to read that story, everything changes. So today I'm going to teach you the foundation of technical analysis, the skill of reading price charts using real charts that I've prepared for you. That by the end of this video you understand candlesticks, trends, market structure, support and resistance, and trend lines. So let's get into it. Before we look at charts, let's define what technical analysis actually is. So in simple terms, technical analysis is the practice of studying price charts to predict future price movements based on what price has done in the past. And it works on one core belief that price moves in patterns and those patterns repeat. Not because price is predictable, but because human behavior is predictable. Fear, greed, hesitation, these emotions show up on chart in the same way over and over again. So technical analysis is how you learn to recognize these patterns and trade with them instead of against them. Now let's start with the most basic building block of every chart, candlesticks. Every Forex chart is made up of individual units called candlesticks. Each candlestick tells you exactly what happens to price during a specific time period. So here on this chart, I have broken down the anatomy of a candlestick for you. Every candlestick has 4 key pieces of information. The open, which is where price started at the beginning of that time period. The close, which is where price ended at the close of that period. Then we have the high, which is the highest point price reached during that candle. And then the low, which is the lowest point price reached. The body of the candle is the thick part, and it shows you the range between the open and the close. And then the thin lines above and below the body are called wicks or shadows. They show where price spiked but could not hold. The color of the candle tells you the direction. For a bullish candle, price would close higher than it opened, and it tells us that buyers were in control. And for a bearish candle, price would close lower than it opened, and it tells us that sellers were in control. The open, the close, the high, the low, the body, and the wick, whether bull or bear candle. Every chart you would ever read is built from these. So now that you understand individual candles, let's zoom out and talk about trends. So what is trend? A trend is simply the general direction that price is moving over a period of time. And there are 3 types of trend you would see on any chart. We have the uptrend, a downtrend, and sideways or ranging market. For the uptrend, price is making higher and higher movements overall, signaling that buyers are in control. For the downtrend, price is making lower and lower movement, signaling that sellers are in control. While for a sideways or ranging market, price is moving horizontally. In this kind of market, neither the buyer or the sellers are in full control, and this is also called consolidation. Now let me show you how to identify a trend more precisely. This is where market structure comes in, and it's one of the most important concepts in technical analysis. So in an uptrend, price makes higher highs and higher lows, such that every peak is higher than the last and every pullback is higher than the last. The label you see, HH, are for higher highs, while HL are for higher lows. So in a downtrend, price makes lower lows such that every peak is lower than the last and every dip goes even deeper. And we label these LH for lower highs and LL for lower lows. Now, why does this matter? It matters because market structure tells you the trend, and trading with the trend is one of the most reliable edges that a beginner can have. So never fight the trend, read it and trade with it. Now let's move on to one of the most powerful concepts in technical analysis, called support and resistance. Support is a price level or zone where price tends to stop falling because buyers outnumber sellers at that level or point. So now think of support level like a floor. Price drops down, hits that level and bounces back up, just like the tennis ball would do. While resistance is the opposite. It's the price level where price tends to stop rising because sellers outnumbers buyers. So now think of resistance like a ceiling. Price rises up, hits that level and get pushed back down. Now look at this chart. You can see price bouncing between these two zones repeatedly. And that is a ranging market trapped between support and resistance. Just like we had in the example of the ceiling and the floor. So now here is where it gets interesting because this is something most beginners don't know. When a resistance breaks, it often becomes a new support. And when a support breaks, it becomes a new resistance. This is called role reversal, and it is one of the most reliable patterns you'd ever see on a price chart. The reason it works is simple. The same level that is important to sellers on the way up becomes important to buyers once it breaks. So we can say all this happens because the market has memory. So the last concept for today is trend line. Trend line is a diagonal line drawn across a series of price points, connecting the highs and the lows of the trend. In an uptrend, you draw the trend line by connecting the rising lows. This creates a support trend line, a dynamic floor that price tends to bounce off as it continues upward. And in a downtrend, you draw the trend by connecting the falling highs. This creates a resistance trend line, a dynamic ceiling that caps every bounce. So if you look at this chart, you see both of them in action. The uptrend trend line acts as support and price bounces off it multiple times before the trend changes. And now you also notice the labels on the chart, ROBS and SB arrow. ROBS stands for support becomes resistance. When price breaks above a level and that level holds as support on retest. For SB arrow, it stands for support becomes resistance. When price breaks below a level and that same level then rejects price on retest. If you remember, these are the same role reversal concept that we just discussed. Just apply it to trend lines. Because when trend line aligns with support and resistance, you have some of the strongest areas on any chart. Let's recap what we have covered today. We started from candlesticks, which is the building block of every chart. The open, the close, the high, the low, the wicks, and the body. Then trends, uptrend, downtrend, and ranging market, which is identified using market structure. And for market structure, we have higher highs and higher lows for an uptrend, and then we have lower highs and lower lows for a downtrend. And for support and resistance, we talked about the floor and the ceiling of price and how they swap roles when they are broken. Then the last concept we discussed was trend line, a dynamic support and resistance drawn across price swing points. These 5 concepts are the foundation of technical analysis. Every strategy, every setup, every trade is built on top of these 5 concepts. And in the next video, which is part B, I'm going to show you how to put all of these together on a real life chart. A full walkthrough all the way to identifying trading opportunities. So that video is going to connect every dot we have covered so far in this series. So subscribe so you don't miss it, and I will see you there. My name is Good Hayes, and this is Simple Forex Secrets. Bye-bye.